Welcome back. In this video, we're going to explore a different angle on NIO, one that's been flying under the radar a bit, but might just be the company's most powerful weapon going forward. While everyone's been watching delivery numbers, short interest, and near-term price movement, NIO has been quietly building something that most other EV companies don't have, a rapidly expanding, increasingly profitable battery swap network. And what if I told you this battery swap network might be the key to NIO's long-term survival, and maybe even its dominance? Now, before we go deeper, let's set the stage. NIO has been in the spotlight again this past week, following a strong rally in its stock, solid June delivery numbers, and a growing conversation about the potential for a short squeeze. The sentiment has shifted, at least for now, from doom and gloom to cautious optimism. We've already covered that momentum and the profitability roadmap in earlier updates. But here's what we haven't talked about yet, something that may be even more important in the long run. While Tesla, XPeng, and others are investing in fast-charging infrastructure or partnering with third parties, NIO has taken a completely different path. They've gone all in on battery swapping. And recently, it started to look like that gamble might actually pay off. As of now, NIO operates over 3,100 battery swap stations across China. That number alone is impressive, but what's more important is that the economics are starting to work. According to the company, around 20% of these stations have already reached break-even, meaning they're no longer losing money. In major cities like Shanghai, many stations are now operating at or near profitability. That's a big deal. Because for a while, critics saw battery swapping as expensive, niche, and unscalable. But if NIO is proving they can make these stations profitable, especially with high usage volume, then suddenly this isn't just a customer perk, it becomes a long-term revenue engine. And now we've got another important piece of the puzzle. CATL, China's biggest battery manufacturer, just made a strategic investment into Mirattery, which is NIO's battery swap joint venture. This is the same CATL that supplies batteries to dozens of automakers around the world. Their involvement lends a lot of credibility to the model. They clearly believe in it enough to put money into it. This brings us to the bigger question. What if NIO is quietly winning the infrastructure war in the EV space? Think about it. Most EV makers are focused on building great cars, sure, but they're relying on third-party charging networks to support them. Tesla is the exception, but even then, charging takes time and requires significant space. NIO system, on the other hand, allows drivers to pull into a station, swap out their depleted battery for a fully charged one, and drive off in under 5 minutes. It's fast. It's convenient. And it removes one of the biggest barriers for EV adoption, charging anxiety. And from a business perspective, these stations have multiple benefits. They generate service revenue. They improve brand stickiness by locking users into NIO's ecosystem. They open the door to battery-as-a-service subscriptions. And they provide NIO with valuable user data and energy usage metrics. What's even more impressive is that these stations are modular. As demand increases, NIO can scale capacity. In high-density regions, they're already seeing 60 to 70 swaps per day per station. That's the break-even threshold. As more drivers join the network, especially with the launch of lower-cost models like the Onvo L60 and L90, utilization is expected to rise. Now, let's take a step back and think like an investor. Infrastructure is hard to replicate. It requires capital, planning, and time. Once it's in place, though, it creates a moat, a competitive advantage that's difficult for rivals to copy. If NIO keeps executing and expands this network beyond China into Europe and other markets, this could become their defining edge. So while Wall Street is debating whether NIO will meet its Q4 2025 profitability target or whether short squeeze is imminent, there's this quieter, more strategic story unfolding beneath the surface. And it's one the market hasn't fully priced in yet. That brings us to what to watch next week. We're likely to hear more updates about station rollout, especially any news tied to regional profitability or CATL's role in expansion. Also worth watching is how this infrastructure integrates with new vehicles, like the Onvo L90, which are expected to hit the market starting August 1st. If NIO can show strong early demand for these vehicles and highlight how battery swapping adds convenience for families and daily commuters, that's going to reinforce the infrastructure narrative. And let's not forget, we're still dealing with elevated short interest. With roughly 191 million shares sold short, close to 10% of the float, and borrow fees rising, the stock remains vulnerable to any upside catalyst. If positive news hits around battery swap profitability or expansion, that could light the spark. So here's the big takeaway. NIO isn't just an automaker. It's building an ecosystem. And the infrastructure it's putting in place today could be the very thing that secures its future 5 or 10 years from now. Battery swapping may have seemed like a risky bet at first, but now it's looking more like a quiet win in the making. Thanks for tuning in. I'll be keeping a close eye on any developments around Mirattery, CATL, and NIO station profitability. If any major updates break, I'll bring them to you here. In the meantime, stay sharp, stay skeptical, and keep looking beyond the headlines. Because sometimes, the biggest moves are the ones nobody's talking about, until it's too late.